a bit of a problem, because if I'm buying stocks, I've got a choice about what stocks to buy. If I've got billions of dollars of cash on my account because I've just sold out massive amounts of put options, I've still only got cash, I haven't got stocks. Now at this stage, of course, as a fund manager, I've got a big choice to make. I've got to try and decide, where do I apply that cash to get the best return for my money, the safest and the best return for my money. Now, obviously, I want to be long equities, but which equities? Buying the index, perhaps. I could go along the index. I could buy up a lot of index long positions, perhaps some calls. But obviously, the idea is, if I'm buying an index, I'm not buying a dividend, unless, of course, I want to get into individual index tracker type products. But generally, as a rule, if I'm buying a basket of shares because I want to get dividend payments for my clients, perhaps it's a pension fund, then of course I've got a choice to make, because if I buy growth and they don't produce dividends, then they better well go up in price, right? If I buy dividend, at least I'm getting dividend regardless of whether stocks go up or down, and that's why they're very good defensive stories. Well, this is part of the storyline that we've been talking about this morning, isn't it? We talked about the narrative of what was happening in these areas here. So the question is, would you have liked to have known about these buys and sells? Would you believe that if you knew about these buys and sells, you could have done quite good on a daily chart on the S&P? Well, I think the answer is, damn kidding right I could. So what are these arrows? Well, these are arrows that are all associated with rotational business. Now, we're getting very specific in this rotational business because I want to try and make sure you get it, because a lot of people will still hum and haw about the idea of the S&P against the Dow Jones, or the NASDAQ against the S&P, and all of these kind of things. And the reason why is because there's a lot of crossover components in the various indexes, right? So one of the ways we can get very specific is we can say group an index, and we can look at how a sector's performing inside the index. Not necessarily the index, but an index. For growth, it's always good to use the Qs because it obviously includes a heavyweight component on tech type stocks, lifestyle type of businesses, the world of some of the other high tech companies. So these are kind of a lot of lifestyle type businesses that do well in recovery periods, but they don't produce an awful lot of dividend income because they're innovative type companies. They are trying to grow. They're trying to build a brand new product. They're trying to be innovative. Innovation, as a rule, doesn't come as a cash cow. And therefore, as a result, they are growth type stocks. Their price to earnings are through the roof. So obviously, that's the idea. The price to earnings are through the roof. You don't pay much dividend. Now, the good thing about this is we can analyze this by looking at it against not utilities per se, and obviously not, because obviously utilities are very, very dependent upon how the underlying input costs are going, because we've got the problem of things like, a supplier, for example, that's facing a very, very large increase in input costs, and they find it very difficult to pass that cost on to individuals, simply because perhaps there's even a government cap on that cost. So therefore, their profit margins actually might start getting hit, even though they happen to be in that space. And you might be saying, but you're opening up a can of worms here, because that's going to start involving me doing an awful lot of research. No, it's not. There are plenty of dividend ETFs. We've talked about many before. We chatted about the Dividend Kings, for example. There are a lot of dividend ETFs that you can actually use to try and understand these rotations. And obviously, if dividend ETFs are getting a buy, it means that, so somebody's already done the research, somebody's already done the work for you to find the best dividend stocks, hence the reason why they're in the dividend ETF. Somebody's done that work for you. So you're employing their abilities, right? You're employing basically the best analysts that Schwab have if you're going to use one of the Schwab ones. Now, Schwab's a very good company for us to use. So I'm using the Schwab dividend product, SCHD. So that's the ticker name, okay, SCHD. and I'm comparing it to the Qs. Take a look and see if this comparison gives us any insight into what's going to happen in the marketplace. Does that give us any insight into what's going to happen in the marketplace? Well, yes, it does. We can all agree that the top edge is incredibly obvious. Now, this is just this one swing. We can do this on a daily basis, of course. But we can all agree that the top edge is very, very, very clear that there is a big rotation into dividend stocks, not just safe stocks, but dividend stocks, specifically dividend stocks, regardless of index, at the expense of the high PE companies in the queue. So we can see that this is a very, very strong narrative building process. We can see the weakness of this rally. There's no growth stocks getting purchased on that rally. During this rally, it seems about fair value. And then during this drop, there seems to be absolutely no growth stocks being purchased on that pullback. There doesn't seem to be too many stocks being purchased on that pullback. And there doesn't seem to be any growth stocks being purchased on this pullback. Now, you might be saying, yeah, but the problem is, Ray, come on, seriously, this is hindsight stuff, isn't it, when you think about it? When you look back at these charts, they always look great, don't they? Yeah, they do always look great. But obviously, one of the things that we start to understand is that, we talk about this all the time in the class. We actually mentioned yesterday, before yesterday's drop, one of my concerns was the lack of growth at the top edge. Lack of growth stock purchase at the top edge. Did we mention this, yes or no, yesterday? I'm pretty sure you must have heard me if you were trading equities, made a note of it if you were trading equities. Because it was one of my main points. Was one of my biggest concerns was a lack of growth stock purchase toward the top edge prints. Is that visible from this chart? Absolutely. Absolutely crystal clear. So when we see this, we obviously start watching it, we start understanding it. And when we zoom into the individual candles, we can actually start making sense of it. Take a look at the individual candles. You see the vast majority of the individual candles seem to be fair value. If I look at the last couple of signals, you can see, for example, during this signal here, that little spinner candle, which closed at the same price as the open, but there was a big rotation into dividend stocks at higher prices. Well, that can't be bullish, surely to goodness. And sure enough, the next day we had a nice sell-off followed by a following sell-off. Into this balance area here, divergence, not the strongest, but it was given away by this big up candle. That big up candle was not generated by people buying growth stocks. Do you see the point I'm making about narrative building? Is this sensible, Mike? Is this a sensible process? Of course it is. If I see the index going up heavily on utilities buying, do you know what I mean? If I see indexes going up on utility buying, I'm not thinking that the index is incredibly strong. Why? Well, if it was incredibly strong, why the hell did they buy utility buying? You know what I mean? Why did they buy utility buying? What was that all about? Well, of course, it's a defensive play at higher prices. Well, why is it defensive? They're not going to make much money at higher prices. So, give you an example. I'll make a lot more money if the market goes up by owning a growth stock than I'll ever make if I own a dividend stock, right? That's as simple as it gets. There's a lot more ceiling, to use that phrase, there's a lot more ceiling to a growth stock upside than there is to a dividend payment. So a dividend payment, 3%, 4%, the upside of a stock, 20%, 30%, 40%. See what I'm saying? The dividend payment of 3% kind of basically evaporates into a puff of fresh air when you compare it to the potential of growth. So when we see a rally taking place and it's not fueled by growth stocks, I'm worried about top edges, hence the reason why there's a line there, hence the reason why there was a sell there, hence the reason why we made a fortune there. As we came into this top edge, previous swing levels here, you can see that again, this little rally yesterday, 2 days ago, was not fueled by growth stocks. It was fueled by defensive stocks. And you can see that from the divergence on these two candles. And then the next day sell-off, spectacular. Now, let's see what happens today. Let's see what happens today, guys. 4 minutes into the 4 minutes before the cash open. Let's see if we start seeing a rally from the open on the back of attacking growth stocks. Or let's see if they buy defensive stocks again at bottom edges and they rotate out of growth stocks. There's going to be a big clue about the shape of today's markets. Now let's take a look at it on a lower time frame from yesterday. Let's drop it down to a 5-minute chart to see what happened yesterday. Do you see what happened yesterday? Take a look at the close of yesterday's market. Do you see that detail? Yes or no? Do you see that close of yesterday's market? Yes or no? Do you see that it was not fueled by growth stocks? It was fueled by dividend stocks. That is a defensive rally, correct? We would think about this as a defensive rally. And obviously what happened at the close, we've opened the gap down that day, and obviously the sell-off here was pretty obvious, straightforward. So let's see where we open up today, guys. Let's see where we open up today. All good?